So let's look at the current environment today and why we're launching this fund at this time. Over the last 5 to 10 years, the Federal Reserve has had no choice. They have had to try to keep interest rates artificially low in order to spur growth in the economy. Not only did we see massive fiscal stimulus, not only did we see massive monetary stimulus with the Federal Reserve lowering interest rates, but we also saw the stimulus response to COVID. When COVID hit, we saw the Fed grow its balance sheet by 140%. And obviously, as everybody knows, Congress gave money to people for free just to try to stimulate the economy. All of this created this enormous amount of demand, a demand shock. At the same time, we had a supply shock because of supply chains, et cetera. And so inflation took off. And so we now have the highest level of inflation we have since the early 80s. The Fed really didn't have any choice at all. They've had to raise rates faster than they've ever raised rates in history. Well, they also have started to shrink the balance sheet because they need to. So the shrinking of the balance sheet, the raising of interest rates, has created this terrible environment, which is stagflation. Stagflation is really the worst of all worlds for stock and bond investors. What this shows is going all the way back for 50 years. There's only been one economic regime where the 60-40 portfolio has lost money on average over the entire 50-year period. Stagflation, stagnating economy, high inflation, it's bad for pretty much every asset class. Not all, but most asset classes. So the other thing that we've seen is the yield curve has gone massively inverted, the most it's been almost in history. What does this tell you? Well, when short-term interest rates are much higher than long-term interest rates, the yield curve is inverted. That has signaled every recession since World War II. This time's not going to be different. We're going to have a recession. It's probably going to be pretty painful. It's likely to create dislocation in asset prices. It already kind of has. We think that's going to continue. The consumer's under a tremendous amount of stress as well. This shows the interest rates on credit cards. It has spiked dramatically with the increase of rates from the Federal Reserve. So you're talking about over 20% interest on credit cards. Hopefully you don't have any credit card debt. If you do, you need to figure out how to pay it off because 20% is unsustainable. What we're seeing now is the credit conditions are actually as bad for the consumer as they have been since 2008, 2009, since the middle of the global financial crisis. And just one data point, auto loans. Right now, you're seeing more delinquency, people overdue in their automobile payments than we have seen since the middle of the global financial crisis. Unemployment hasn't even spiked yet. And yet we're seeing this many people who cannot pay their bills on their automobile. So we're seeing opportunities in several asset classes. Let's talk about a few. Distressed debt, the opportunity is near. We're now seeing more bankruptcy filings by month than we did during COVID, and almost as much as we did in 2008, 2009. You see real estate debt. This is kind of a slow-moving one, but it's going to be a problem. The amount of maturities of debt over the next 5 years dwarfs all maturities that we have ever seen in commercial real estate. That real estate is going to be very difficult to finance. Interest rates are higher. Occupancy levels in many cases are lower. That's a bad recipe. You haven't seen the foreclosure start yet, but they're probably soon to happen. So let's talk about the current opportunities of where we're actually looking to deploy capital right now. The energy market is severely dislocated. Now, to be very clear, we are supportive of all types of energy. Wherever the energy comes from, that's what we want. We want it to be as clean as possible. We want it to be responsibly sourced. We want it to be, most importantly, predictable. We want it to be inexpensive. And we want it to be there when we need it. And what is happening is the lack of capital is creating one of the biggest dislocations that we have ever seen, and that unfortunately not enough people are talking about. So because of reasons that are not economic, many people are choosing to not invest in parts of the energy sector. And this is creating a capital markets supply shock, which is dramatic. It's as dramatic as anything we've ever seen. So capital investment in oil and gas has dropped, whether it be bank debt, private equity, or public equity. Energy demand, though, is not going to stop growing. We're going to have more people on this planet, in 2050 than we have today. A lot more people. And many of those people are going to be elevating their lifestyle. They're going to move out of poverty and into middle class, or they're going to move out of middle class into the upper class. All of those folks are going to be consuming more energy, and the world has got to meet that demand somehow. The energy evolution will take many years. To be clear, we're going to continue to find new forms of energy. We're also going to find new ways to consume energy as well. But an evolution of energy is really more of an addition of new types of energy. As an example, it took over 50 years for coal to become 35% of the global energy supply. It took over 50 years for oil to become a meaningful part of the world's energy supply. It took over 50 years for natural gas to be meaningful. We've been at it with nuclear for 50 years, and it's just 9% of global energy supply. And in the world of renewables, we've spent trillions of dollars over the last decade, and we're at 3%. Now, it will grow and it will increase, and we want to profit from that. But most importantly, we know that all of this energy demand is going to require new supply. So we are much more in the all of the above category. We want it to be responsibly sourced. We want it to be as clean as possible. We want it, most importantly, to be predictable and inexpensive. We want people to be able to afford it, because human beings will flourish when they have affordable energy. So when you look at the past, you see that we've had this enormous growth in energy demand. And when we look at the future, that's going to be the same thing. So we're going to need all of the above. We're going to need fossil fuels. We're going to need renewables. We're going to need things that we haven't even thought about yet in order to be able to meet all of the demand. So we want to invest in all of the above. We want to invest in fossil fuels. We want to invest in transition assets. We want to invest in new technologies. We want to invest wherever, however, we can create energy for the world that actually is going to be profitable for us as investors. On the left, you have global liquid supply, think oil, and on the right, you have natural gas. And what the dotted lines show is the current supply and the current demand. And as you can see, it's pretty close. This should get everybody's attention. The dark blue shows the decline curve. I think everybody knows this, but to make no assumptions, when you drill an oil well, you don't get to pump it forever. It runs out. That is called depletion. And so you have a depleting asset. Eventually, it's going to go away. What this chart shows is that if we do not increase the global supply of oil and natural gas, it's going to drop by over 75% over the next 20 years. Well, one thing that everyone should be aware of is that doesn't mean you just need to find some new. No, you need to find enough to replace everything that is being used, everything that is being depleted. And what is so critically important is that energy security is national security. So if we do not produce enough in the United States, or other parts of the world don't either, they're going to be forced to buy their oil and buy their gas from people that generally don't like them very much. We saw this most recently in Europe, where they were buying almost all of their energy supplies from Russia. Well, when Russia invaded Ukraine and turned off that spigot, it created chaos in their economy. Energy security is national security. We need to invest in all types of energy, which means oil and gas as well as renewables. It is critical to our future. It is critical to our country. If we do not invest in all of the above and generate the energy that this world needs, we're going to have a price shock. We're going to have a dislocation where prices will go up very, very dramatically, and that could have an enormously negative effect on the worldwide economy. So the opportunity is created from this dislocation of supply and demand. So there is no credit market availability for oil and gas. There's virtually no public equity capital for oil and gas. What that means is there's no buyers. If there's no buyers, what happens to price? Prices drop. If prices drop enough, you have a tremendous dislocation and a lot of profit opportunity. That's what we want to do.